Welcome back to the Bitcoin Layer. I'm Nick Bhatia. Today, I go through a global macroeconomic update. We'll discuss the balance between fiscal dominance and restrictive monetary policy. And of course, we will take a look at Bitcoin price action. Let's start with inflation. We have a great heat map for you showing inflation in the United States, CPI, the weightings, and how each individual part of the inflation index has evolved over the last several months. Now, I'll point you to one area here, and that is the shelter component of CPI. As you can see, shelter and overall housing is 45% of the index, shelter 36%, and shelter is well over 5.5% annualized inflation right now. So that is keeping inflation where it is. We're not seeing a draw back to 2% where the Fed wants to see it. We know the Fed wants to cut rates, nevertheless. We'll discuss that more in this video. But I want you guys to look at how sticky inflation has been because of this shelter unit specifically. The Bitcoin Layer is sponsored by River. Make sure to check out river.com today or the link below in the description. River is our preferred place to purchase Bitcoin. Now, when you're buying Bitcoin, guys, there are several considerations. Number one, should I be using an exchange? Is the exchange custodying their own Bitcoin? Is the exchange using platforms to custody that we don't know? Is the exchange leveraging its Bitcoin for other purposes? Well, with River, we know that River does not use leverage of any kind. River also uses its own multi-sig solution so that your Bitcoin are not held by anybody else. So it's a very important thing to understand about what River offers. Now, River also has Lightning Network integration and a lot of other really exciting features. Go check out river.com today. And now let's look at the hot part of the heat map here. These are the areas in red. And what you're looking at from the right side is trailing 12 months, and the left side is going to be February of 2024, so the most recent month's reading. And we see that the heat right now is in transportation, insurance, and private transportation. Basically, the auto part of inflation index is really driving some of the marginal inflation right now. So this is just something to look out for, and we will continue to bring you these heat maps on inflation, not only here in the United States, but around the world. The next table here is a central bank tracker. So what we are doing is we're looking at the major economies around the world. On the left-hand side, we're looking at CPI, or the inflation index. Next, you have the policy rate, the last decision, whether green meaning a cut here and a red number meaning a hike. Then you have the last move and the number of months since the last hike or the last cut. So that's the table from left to right here. And what can we see? We can see that the last move, cut versus hike, is starting to show up green here, meaning that we are starting to get easier policy in different parts of the world, not just this blanket hiking cycle everywhere you look because of inflation. And the inflation index itself is heat mapped here as well for you to show you that there are some parts of the world where inflation is either near zero or actually below zero. And in those parts of the world, you are seeing central banks start to cut the policy rate. Now, toward the bottom of your screen here, we see Switzerland. This is something we talked about recently. The most recent move from the Swiss National Bank, or the SNB, was an interest rate cut. That happened last week. Now, we are watching very closely in this next chart the global central bank's path. And what we mean by path is, what are the futures markets pricing in? What are these swaps markets and futures markets pricing in for the policy rate at specific points in time in the next 3 to 6 months? And what we're seeing in Europe is a cut being priced in now, only a couple months out, and the Fed is still priced in for a June interest rate cut. We are biased to believe the interest rate futures markets once they get within 3 months to the policy decision itself. So what we are seeing here with a June interest rate cut still being priced in almost all the way here in the US, we can start to consider a June interest rate cut as the base case scenario for the market at large, even though I know that we've had a June cut as our base case scenario since December of 2023. In this next chart, I want to show you the 2-year yield in US Treasury land versus the Federal Reserve's policy rate. So the policy rate is in black, the 2-year yield is here in orange, and on the bottom pane, what you have is the difference between these two rates. And when this rate is below 0, it means the 2-year yield is trading below the policy rate. And what that usually means, based on historical examples, is that the market is expecting the policy rate to come down eventually, and the market does end up leading the Fed, meaning that the Fed does end up obeying the market and bring the policy rate to where the market is pricing it. Now, as we can see, the 2-year yield has been inverted to the Fed funds rate for well over 1 year. And so we can't just say that because the 2-year yield crosses below the policy rate that you're going into cuts right away. But it is a leading indicator and it can take a long time. For example, when this policy rate went inverted in late 2022, it also suggested that the Fed's policy rate would potentially stop going up at the pace that it did, or potentially even stop going up entirely. And that would have been early. That prediction would have been early, as the Fed did raise rates a few times after that point. But what we saw is that after March of 2023, with the Silicon Valley Bank collapsing, that it was at the tail end of this hiking cycle. So the inversion of this spread really does give us a great leading indicator. It's just that sometimes it takes months or even well over a year for it to play out. But we do expect the policy rate to start coming down, like we said, in June. But even if it doesn't start coming down in June, the Fed is guiding the policy rate lower. So maybe by July, or maybe 50 basis points instead of 25 in the fall. We're not exactly sure how and when, but what we are certain of, more and more certain of, is the path and how that path is clearly now headed lower. Now, the next chart I want to show you is the 10-year yield in treasuries versus the oil-gold ratio. This is something we've shown you guys. We want to bring it back here. The ratio in black gives us a sense. Oil divided by gold. What does it tell you? Oil should be associated with economic growth and production, right? As crude oil is an input in economic production. Gold, what is gold? Gold is a monetary asset. It is an asset that is not a liability of any bank balance sheet. It is a bearer instrument. It is a hard asset. And so just like Bitcoin is a hard asset, even though it's virtual or digital, it's still a hard asset in that it is a non-liability. So we have an economic production asset in oil, a monetary asset in gold, and the ratio should give us a sense of what is the growth impulse around the world, or what is the impulse to buy oil and sell gold. Think of it the other way. In what scenario would you sell gold to buy oil? You would do so if you were very bullish on the economy. Selling gold to buy oil is an expression of, I want to sell something that's a monetary reserve and a safe asset for something that is highly consumable and can potentially lead to some sort of profit opportunity for me by buying oil and using that oil. So the oil-gold ratio tells us something about the growth impulse and the growth expectations in the economy. And we do see a relationship between the oil gold ratio and the 10-year yield, as the 10-year yield is also an expression of growth and inflation expectations in the global economy. So, a low oil to gold ratio should be correlated with a lower treasury yield, as investors are basically saying we would like to sell oil and buy gold and buy US treasuries. That's what really this chart is showing us. So, oil gold ratio staying low, treasury yield starting to leak higher. As we can see, there might be some deficit or debt implications that is steepening the yield curve at the margin. That's something that we're talking about a lot more in our research publication. So make sure you guys are subscribed to our free research publication at thebitcoinlayer.com/subscribe, where you can follow along with all of these charts as we continually bring you a detailed economic analysis all the time. So in this ratio here, we see oil to gold leaking lower or staying where it is. Treasury yields starting to go up a little bit, but still holding the same shape with this oil to gold ratio. What it's telling us is that there isn't a lot of bullishness in the global economy using these major asset classes of oil and gold as a comparison. Next topic is fiscal dominance. Now, this is something we've been covering. Fiscal dominance is the idea that an enormous fiscal deficit or a large amount of government spending can potentially overpower monetary policy effects. Now, what we are seeing right now is reminiscent of fiscal dominance because the large fiscal deficits of $10 trillion cumulative over the last 5 years has clearly driven so much spendable money in the US economy. It's keeping inflation hot and it's keeping nominal GDP growth very, very high. When the Fed raises rates from 0 to 5.5%, it is hoping it can slow down some of this fiscal dominance and fiscal deficit spending really goosing the economy. But what instead has happened? Something has happened here called the interest income channel. This is an idea that the government is borrowing so much money that the lenders themselves are out in the private sector, and the lenders are the holders of US treasuries. So the lenders are receiving more interest income as rates go up. Rates go up on the policy level, and they end up going up on treasuries as well. And so the treasury securities owned by the people, the investment houses, they are receiving more money now, interest income from their treasury holdings, and that is leading to more spending in the economy. What I am most interested in is that dynamic cannot last forever when you have high level of nominal interest rates and you have real borrowers in the economy. Now, we mentioned that the government is the large borrower here, so that the lender is the private sector. But is the private sector only a lender? No, absolutely not. We know that the private sector is a borrower in the housing market to the tune of trillions. It's a borrower in the auto market. It's a borrower in the credit card market or in the consumer market to the tune of multi-trillions in each and every one of these sectors. What does that mean for monetary policy? It means that when rates go from 0 to 5% and mortgage rates go from 3% to 7% and auto rates go from 4% to 15%, that will have a restrictive effect on the consumer and the US economy. That is independent of those that own treasuries receiving more interest income and having more spendable income. So the two are in a tug of war. Fiscal spending leading to large lenders in the private sector, as well as just this aggregate borrowing in the private sector that we know to be true. So these are the two forces at play here between fiscal dominance, fiscal deficits, and restrictive monetary policy and 5 to 7% rates in most of the safe borrowing world. And I'm talking about investment grade corporates and households that are buying homes and having mortgages with relatively good loan to value ratios. What is the conclusion here? The conclusion is that even though we have large fiscal spending driving the economy forward, the impulse from fiscal spending will at one point give way to the restrictive monetary policy affecting the borrowers in the private sector itself. We don't know when that will happen. We had a great conversation this week in which we got an opinion that this economy might stay strong for another 1 to 2 years, just given the amount of fiscal deficit. We did a video recently on 10 trillion in cumulative deficits. We suggest you guys go check that out. Okay, I promised we'd get to Bitcoin price action, and let's conclude with that today. We know that Bitcoin trades today above $70,000, right at its all-time high. We have the halving coming up in a couple weeks. We have large ETF flows, despite actually seeing some net outflows on a day-to-day basis throughout March. The overall flow numbers are still wildly impressive. So what's going on with the Bitcoin price, and how can we think about this bull market as more and more people get focused here on the price? And this would be my advice to you guys at home thinking about Bitcoin here in this bull market. You need to expect the unexpected when it comes to Bitcoin's price. It is a wildly volatile asset. It has a history of going up by magnitudes, meaning multiple times itself, as well as having 80% drawdowns. It also has a history of having regular 30% drawdowns in bull markets. So the way I want you to think about, can Bitcoin go from here at 70 down to 60 or down to 50 before it goes up again? Of course it can, and you should probably expect bigger moves than you can imagine. And that would be the way to give at least yourself some expectation of how to deal with this outsized volatility. But I'll just let you in on the way that I'm thinking about the numbers to prepare myself for future moves. So I am expecting six-figure Bitcoin. We've talked about that a lot. Remember, subscribe to our free research letter at thebitcoinlayer.com/subscribe. When I think about the Bitcoin price hitting 100,000, I think about profit takers. And I think about on the way up from 80 to 90 to 100, you will start to see leverage longs get into the market and place these leverage bets on Bitcoin, just trying to purely chase the momentum. I am mentally expecting a move from 100 back down to 70. And in that way, you set your own baseline expectation for 30% drawdowns or even more. That way you can experience the entirety of the bull market before it actually gets exhausted. So I don't know when this bull market is going to end. What I do know and what I'm telling you is that I expect large 30+% drawdowns before the thing is over. So that's why I'm thinking about the move from 100 to 70, just to mentally prepare for what we are about to engage in this bull market with an enormous amount of bull market energy. We mentioned the strength of the economy. We mentioned $10 trillion of cumulative fiscal deficits. Where is that money going? Some of it is ending up in financial markets, and some of that money is ending up in Bitcoin. So there is an impulse here helping to drive Bitcoin's price higher. We'll catch you guys next time at the Bitcoin Layer. Make sure to subscribe, like this video, and let us know your feedback, what you want to hear from us next. Special thanks to River for sponsoring this channel. Purchase Bitcoin without any fees when you use River's DCA feature. River has become our trusted source of accessing the Bitcoin market because they don't use any third-party custodians. This is a very, very important thing to understand. River is not using another company to store the Bitcoin for them. They have their own multi-signature solutions, which means that they have designed their own way to make sure nobody else has responsibility for the Bitcoin for the time that you have River hold your Bitcoin for you on their platform once you have purchased it. So go check out river.com today. Thanks for sticking with us. As always, at the Bitcoin Layer, subscribe to our channel. subscribe to our Substack at thebitcoinlayer.substack.com so that you can follow along our latest research and analysis.